12.5%. That's the average return of equities since 1950. Compare that to bonds, which has had an average annual return over the same period of about 5.9%, less than half of what you could get in equities. It really begs the question, why would you ever add bonds to your portfolio when they have, historically anyway, the potential return of so much less? Given that this month the theme is bonds and the roles they have in your portfolio, it makes me think of the other Bond, James Bond, and his favorite cocktail, the martini. If you strip away all the ingredients and just take the core of the drink, the strength of the drink, you're going to be taking a shot of vodka. Whew, that's going to go down a little rough. But if you put that vodka in a shaker with ice, add some vermouth, maybe a lemon peel, and you shake it. You don't stir it. Well, that cocktail, my friends, might go down a lot smoother and have the same effect. This is the Retirement Answer Man Show. My name is Roger Whitney, and this is the show dedicated to helping you not just survive retirement. Come on. We want you to rock retirement. So last week on the show, we started this bond series defining what a bond is. And what we're going to do this week is we're going to dive into what bonds can add to your investment cocktail. It may be more than you think, and we're going to look at it from a scientific perspective of asset allocation, but also talk from the artistic level on the behavioral part that it can help with too. But we can't do any of that until we get done with this all-important disclaimer. So today we're going to be talking about some equity indexes, bond indexes, and realize you cannot invest in indexes. You can only invest in things that try to mimic an index. Past performance is no indication of future results. And different types of investments have lots of different levels of risk, and you definitely should not take advice from me on the show. I am here to give you some helpful hints and education. The only people I give advice to are people I work for as a fiduciary that are clients. So until you become a client, take this as helpful hints and education. Talk to your legal advisor, your tax advisor, or your financial advisor, because that is just common sense. Now let's go talk about why even consider bonds as we're entering retirement. So some of the most successful investors I encounter are people that are entering their 50s, and they've been diligent on the saving and investing aspect of life and controlling lifestyle creep and everything else. But by far, they have embraced the numbers that we talked about at the beginning of the show, that equities, on average, have a much higher return potential than bonds. So they tend to have a lot of equities and be comfortable with volatility in the markets. It's actually been their friend if they've been investing consistently. And that's really important because what happens to when you're accumulating assets when you're younger? Well, you got a lot of time, right? You got 20, 30 years until you ever can imagine touching the assets. You have typically consistency of contributions. So you have what's called dollar cost averaging. So every month, if you put in $100 as an example, and if the markets go down, well, that just means your $100 that you're putting in consistently is able to buy more and more shares because the price has gone down, which means your $100 can buy a lot more. So if you're younger, an '08 catastrophe or a tech wreck really is a benefit to you because you're accumulating money and you have such a long timeline. And when you're in the accumulation mode, it ends up being much more on autopilot because the money gets taken out, let's say 401k, it gets taken out before you even see it. You see it as a line item on your pay stub and maybe when you get your 401k statement, but you never actually put the money in. And any kind of automatic savings works that way, even if you do it as draws out of your savings account. It happens on autopilot. So from an emotional standpoint, you're really strong because you're not looking at your statements because it's forever money and you're not actively having to do anything. And usually I see new clients come to me in that realm because they've been successful accumulators and they're in their mid-50s and they're ready to think about, okay, what do I do with this money now to create or to rock retirement? And they generally have fairly aggressive portfolios, which have done well. Well, when you're getting ready to think about retirement and start transitioning to a life of more freedom, what you've embraced for the longest period of time may not be the best vehicle to serve you when you are actually getting near the time of needing the money. In fact, those same behaviors of having a super long-term time frame, the constant contributions, the not paying attention to it, and embracing volatility as your friend, those same attributes, if you continue those, could really hurt you and impair your retirement. And I think a lot of us don't appreciate that we're changing in the role that we're going into from an accumulator to tapping our wealth to create a great life. Much like, a lot of times the person that is great at starting and ramping the company up isn't necessarily the best person to be the steward when it's a mature company and the game changes because they don't change their habits along with it or they don't have the skill set. Because what happens when you start tapping your wealth or when you're getting close to tapping your wealth? Well, number one, the time frames start to compress. Even if you're 60 and you think you're going to live for another 30 years, you start to have different levels of time frames within that 30-year period. You're not just simply a 30-year investor because you may need some of that money to create the life that you want. I hope you do because you don't want to die with too much money. So your time frames start to get a lot more nuanced and compressed. Your earnings and contributions stop. So you're not contributing to it anymore, or you're getting close to the end of that. And then to exasperate that, that means if markets go down, you're not buying more shares, right? Because you're not contributing. If you're retired and the markets go down, it's not like you're just throwing money back in the bucket and buying more shares. In fact, it's even worse than that because now you're, in a sense, doing the reverse of dollar cost averaging, right? You're on the flip side. It's the dark side of dollar cost averaging. The light side of dollar cost averaging is contributing every month. And when markets go down, it actually benefits you in the long run. The dark side of dollar cost averaging is the reverse, meaning that if you're taking money out in some consistent basis, now when markets go down, you have to sell more shares to get the same dollar amount out to support the life that you're trying to live, which means you have a lot less shares to rebound when the markets eventually rebound. So it can actually exasperate and destroy your plan depending on when that volatility happens. So it's the dark side of dollar cost averaging. And then lastly, the emotional fortitude you had of just not opening the statements, knowing that you're throwing money, knowing that it's forever money, and never really worrying about things. A lot of times that changes on a lot of different levels. And we've talked about that on the show. It changes from, when your earnings stop, you feel vulnerable as a person because you're used to always having this huge income coming in, whatever that number is, this income coming in. You're going with, it's like a stream that has a nice current to it. That income just can solve a lot of mistakes, right? You can just earn your way out of it and rebuild. Well, when you retire or start to ramp down the earnings years, psychologically, that makes you feel a lot more vulnerable. Now you don't have as big of earnings shovel to make up for bad mistakes. And if you've stopped earning altogether, now all you have is the pile of money or investments that you've created. And if that blows up, you're not going to be able to earn your way out of it anymore. So that changes how we think about markets and it changes investing, which makes us much more susceptible to wild swings, but also to emotional behavioral mishaps in how we make investment decisions. So this is a critical time. So that's one big answer as to why you accept lower returns in fixed income, because at least statistically, they provide more stability so we can avoid some of the wild swings that we have when we're just in equities. But in our 50s, we forget, or we don't appreciate enough that we're starting to enter this transition, which means we need to start thinking and managing assets a bit differently because the game has changed. So that's why we're talking about how do bonds fit into this whole cocktail only in this stage in life. And so what I want to do today in the practical planning segment is just talk a little bit about what role fixed income has in the portfolio. And that will set us up for next week, where we enter the fact that we're going into potentially a rising interest rate environment. And then that will set us up for the last week, where we're going to talk about what are some of the more nuanced tools we can do. So we're building a good foundation here. So let's get on with that in the practical planning segment. What role do bonds have in your investment cocktail? It's a really important question. It's a question of what asset allocation makes sense for you, right? What mix of bonds and stocks and various things should you have? In many ways, this is like the martini cocktail. If we take a shot of just vodka, like equities, it's going to maybe give us a great impact, but it could be really harsh in between. Whereas if we add more bland ingredients into the martini or into a portfolio, there's actually an impact of it could be a much better drink and not be near as harsh. That's sort of what asset allocation tries to determine. So we're going to start answering this question or addressing this question from the science standpoint of it. Okay. So how does portfolio science say we answer this question? Because this is what's institutionalized. This is what you're being fed, whether you are using an online calculator or working with an advisor. They're all using an asset allocation model based off of the same things, which is something all based off of modern portfolio theory, which was developed by Harry Markowitz back in the 1950s. So in this episode, I just want us to understand the science behind why we have different asset classes and not just have the highest performing asset classes, and where there's some benefits to that, but also where there may be some negative aspects of that in terms of how it's applied to you if you're close to retirement. So back in the 1950s, Dr. Markowitz, we're not on a formal basis. He pointed out the obvious, that for a given level of return expectation, you're going to try to minimize as many risks as possible, or any rational person would do that, right? And for a given level of risk, you're going to try to get the most return for your buck. That would be the optimal outcome. And so the one premise of modern portfolio theory is that investors are rational. And then he said, well, how do you measure risk? And he chose to measure risk based off of volatility, right? And we have something that will measure volatility, something called standard deviation, which basically measures, if we have an average return, how volatile is the individual experiences around that average. Real simple example I use all the time is in Texas or in Fort Worth, it's average temperature is about 72, but we can get as high as 100 or as low as 20, right? That's a big spread around the average. Whereas in San Diego, where the average temperature is roughly 72, it may get up to 85 and it may get down to 55. A lot smaller or tighter standard deviation. So that's how he decided to measure risk. He says, okay, so if our goal is to maximize return for a given level of risk or minimize risk for a given level of return, how do we build a portfolio to do that? Well, he said, okay, let's just look at stocks and bonds. All right, so he just started with stocks and bonds. And he said, okay, I know what the average return historically has been, so I can put that into my statistical model. And I know the volatility, I can calculate the volatility or the standard deviation for bonds and stocks. And I can calculate something called correlation. This is the last statistical measure, I promise you. Correlation is basically how do two different things move together. So in this instance, we're talking about stocks and bonds. So a correlation of one would mean they would move exactly together. When one moved up by a percentage, the other one would do the same thing. Think of like a marching band. They all march in sequence. Negative, perfectly negative correlation means they do the exact opposite. When one's going one direction, the other's going the other direction. And in most instances, things have a positive correlation, but not totally negative. So stocks and bonds bonds are a lot less volatile. When stocks go up, bonds don't necessarily go up. So they're not perfectly correlated. So he puts these three inputs into a statistical model and says, okay, well, let's start with what is the optimal portfolio to maximize return and minimize risk through all of the different combinations that you can make with those two asset classes. And so you start off with 100% in bonds and no stocks, and then he would incrementally increase to where he got 100% in stocks and no bonds. And then he plotted what the most efficient portfolio would be for a given level of risk between 100% in bonds all the way to 100% in stocks and everywhere in between. Here's what he discovered. He discovered that you could add bonds to an all-stock portfolio, and because it didn't move exactly like bonds moved, that even though the returns historically were lower and the standard deviation was lower, that if you added bonds to an all-stock portfolio, something magical happened. That statistically speaking anyway, you actually could decrease the risk in the portfolio, the volatility, and increase expected return. That is like having your cake and eating it too. I take less risk and I get more return. And even though bonds return less than stocks historically, because they don't move in lockstep with stocks, it helped improve the return expectation of a portfolio. Wow, this was a huge revelation, right? This changed how a lot of people implemented investment allocations or portfolio construction. In fact, it was so important that Harry Markowitz won the Nobel Prize for this. You could add lots of different asset classes. So he started to test that, and people have tested that over the years. But here's what happened, because this is still called a theory, right? Because it's just a statistical model, is that in the 70s, well, let me back up a second. So this modern portfolio theory started to be adopted over time by institutions, foundations, and pensions to set better investment policy to get the most efficient portfolio given the level of risk that they wanted to take. But then something else happened, and that is in the 70s, the Department of Labor issued regulations called ERISA, which in a lot of ways solidified using asset allocation and modern portfolio theory as the safe harbor or best practice in investment management for institutions and individuals running retirement funds and everything else. And then as 401ks came out and IRAs came out, large investment firms started to take those same principles and apply it to individual investors. That's why you take a risk tolerance questionnaire when you're doing your 401k or when you're sitting with an advisor or when you're doing an online asset allocation calculator. Because the one thing it needs is it needs to know how much risk can you tolerate. So that's why we have these risk tolerance questionnaires. So when you are online or you're working with an advisor, usually you're asked a series of questions, and we've gone over some of this in previous episodes. Those questions are trying to determine how much risk you are comfortable with or that you can tolerate, because it needs to know in order to plot where on that efficient frontier your portfolio will be, right? To optimize the portfolio. So when you fill out a questionnaire, it comes up with a score. They put it into their computer model and it spits out the pie chart, the asset allocation, that says, okay, you should have this much in stocks, this much in bonds, this much in cash, and whatever asset classes they decide to throw in there. That's what they say is the optimal portfolio for you. That is standard practice, even with people planning for retirement. But that's the reason from a scientific or mathematical standpoint that bonds have a role in your investment portfolio. Now, there are some big implications of this that many of us don't appreciate near as much. Number one is it assumes that it can determine accurately what kind of risk you can tolerate. And studies have shown, look, we can tolerate risk when we're optimistic, but when we get scared, our risk tolerance goes down significantly. So it's a moving target. So it's very iffy whether we can actually target what our risk tolerance is, which is the whole determinant of our asset allocation. And number two, and this is one I think, I don't know why, most people I don't hear talk about it as much, is that who cares what you can tolerate, even if we're able to measure it? Because now that may be important when you're in the accumulation phase. But when you're where you're probably at in your 50s or 60s and looking to slow down the accumulation and turn on the life maximization, well, who cares what you can tolerate? Really what we need to know is what is and you've heard me say it probably, if you've been listening, the minimum effective dose of risk or volatility we need to achieve the goals that we want. So if you're 60 years old and you're on an online calculator or you're meeting with an advisor and they're determining your asset allocation based on a risk tolerance questionnaire, that means it is not tied whatsoever to the goals that you've laid out for your life. Is that a way to make a cocktail? If I can tolerate something crazy strong, that doesn't necessarily mean it's the experience I want to have. And that's the big issue I have with how people apply just simply the science of asset allocation or modern portfolio theory. Now, the science is important because it shows that lower volatility asset classes can really help make a more efficient portfolio. But what it doesn't do is tie it to people that are retiring. Because remember, if I didn't say this already, this theory works relatively well with institutions who have very long-term time horizons and stability of cash flows and aren't necessarily draining their assets to zero or passing on. They don't die like you or I do. And they have, they're, as an entity, have such a longevity that there's enough time potentially for the statistical numbers to actually work their way out because their time horizon could be 100 years. But you and I, when we're looking to draw money from our assets, even if we're 60 and we may live 30 years, that's not really our timeline from an investment standpoint. We're really more concerned with the early part of retirement when our timeline's the longest. So if you just fill out a risk tolerance questionnaire, it doesn't address any of these issues. So this is really an institutional approach that has been solidified as the best practice for everyone. So that's what we use. Now, the science is good, but it only takes us so far because we do enter seasons when we may not be in a position to where the long-term averages have a good chance of working out. Bonds is the question right now. Is that where we are at with bonds? We talked last week about how bonds have gone down in yield for roughly 30 years, and we may be seeing that change, which changes, we may be in a long cycle of interest rate increases, which is a season that you and I are going to have to endure potentially now, that for institutions, it's a blip in a very long time horizon, but for you and I, it could be the majority of our retirement. So there are seasons around these averages that the way asset allocation is applied doesn't always address. And that's what we're going to have to grapple with. Because for you and I, when we think of the role of bonds, we're going to have to make some decisions. One is, how much of the science do we use? How much of, and this stuff has been studied to death. How much of it do we use? And then how much art do we apply to the science? Someone who's all science is just going to use the questionnaire, implement the portfolio, rebalance annually, and just believe in what the statistics say. That's one extreme. The other extreme is to go all art and just basically trade based on what you're thinking is going to happen. I think the balance falls somewhere in between, and hopefully we can get you enough perspective to help make that decision or help you make that decision in a place that is right for you, and also help you realize when you're going through this process with an advisor or on an online calculator, some of the dangers of just betting on the science. So what we're going to do next week is we are going to dive into more the artsy side and talk about the season that we may be coming into as far as interest rates and what that might mean in terms of how much bonds you want to have in your investment cocktail. So that's up for next week. But for now, let's go get happy with Nicole. Hey, Nicole, welcome to the Happy Lab. How do you get to avoid all of this exciting bond talk?
It's hard work, but somebody's got to do it.
Okay. Well, in the Happy Lab today, since we're talking about cocktails and the role bonds play in a portfolio, let's talk about cocktails for a second. Now, you and your hubby, Mr. Clay, have something you do on date night. What is that?
Well, sometimes on date night in, we like to try making our own cocktails and trying new things. put on a movie. This is what people with young children do, I guess.
Just drink a lot. What is the latest cocktail that you tried that you'd never had before?
We are kind of on a mule kick. I've heard them called different things, but we've been doing it with bourbon and ginger beer instead of vodka, and it's pretty good.
Okay. Now, and you told me the name of the book that you're going out of. What's it called?
Oh, we have an old man drinks book, and a lot of the old man drinks are real bad, like real bad.
And the point of here is
lemon and bitters and bourbon. It was just no.
Yeah, and we're not really encouraging you to drink alcohol. It can be a mocktail. It could be literally a new recipe that you cook up in the kitchen. I think the point of this Happy Lab is that we can fall into ruts, whether it's our cocktails, whether it's our recipes, whether it's how we drive to work. So to keep life spicy, try something new. Even if it doesn't work out, you're going to have a great story.
So fun to try.
There you go. Now let's get on to the Smart Sprint.
On your marks, get set.
Hey, welcome to the Smart Sprint segment, where we make a small little goal that we can accomplish in the next 7 days to take a step to a better life. Now, in the next 7 days, here's what I want you to do. More than likely, you have bonds in your portfolio, and we talked about the different kinds of roles bonds can play. What I would like you to determine is to look at your portfolio. You'll see the allocation you have in fixed income of some sort. And I want you to determine for yourself, what is the role of those assets in my portfolio? Why do I own them? Because that's going to determine the proper mix of your portfolio cocktail. So why don't you go do that in the next 7 days? Hey, Nicole, before we get out of here today, we need to do something.
What should we do?
We need to acknowledge how awesome everyone is. Whether it's Lana, Hugh, Al, Ken, Twyla,
all
Armand.
Our single people that volunteered for Retirement Plan Live.
We had a ton of single people. We get so many questions, and we're working at ways of making sure we answer them all, not just on the show, but individually. Anytime you email with a question or with a comment, you're helping so many other people. Think of the couple that came on last month in the healthcare.
Before Medicare.
Holy cow. I mean, they have done so much research, and how many people did they help because we had a random email conversation? So I just want to say it's awesome to be able to talk with you guys every week.
And thank you for stepping out there and putting yourself forward. Enthusiasm is a form of social courage, guys.
And your comments and your questions help so many people. So just want to say thanks. Now let's go outside. It's a beautiful spring day here.
We appreciate you joining us today for this episode of Retirement Answer Man. Be sure to visit rogerwhitney.com/answers to access the Retirement Answer Library with over 30 checklists to help you make the most of the only life you have. Remember, you have more power than you realize to create an amazing life starting today with Retirement Answer Man. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and no guarantee of future results. All indices are unmanaged and may not be invested into directly. Have a wonderful day.